Okay, let's unpack this. In just a few hours, we're expecting a pretty monumental financial event,
Mm-hmm.
a significant interest rate decision from the Fed. We're talking a potential cut of 25, maybe even 50 basis points.
A quarter to 0.5%, yeah. That can really send ripples, can it?
Absolutely.
Yeah.
But for you, listening right now, for your portfolio, for the broader market,
Hmm.
what does that really mean? It feels like one of those moments.
It really does. And what's particularly striking, I think, is the economic backdrop. It's unusual.
How so?
Oh, well, the U.S. economy, by a lot of measures, is actually remarkably strong. We're seeing GDP growth, what, 3.4% to 4%? That's robust.
Yeah, it really is.
So for the Fed to be thinking about cutting rates into that kind of strength, some experts are calling it very strange.
Right. It kind of goes against the usual playbook.
Exactly. And that context makes understanding the market's potential reactions so crucial. It forces us to look a bit deeper, you know?
Definitely. So our mission for this deep dive is to sift through the sources you sent over some great stuff in there, including analysis from the Micah Stocks YouTube channel
Mm-hmm. Good, Chal.
to understand the immediate market reactions happening right now. And maybe more importantly, we want to uncover the, well, bold predictions from market expert Tom Lee at Fundstrat.
He's definitely got a strong view on this.
Yeah, we want to help you understand not just what might happen, but the why behind it and which specific areas might see what he's calling these monster moves. So let's first zoom in on the immediate market signals. Because honestly, there are some intriguing divergences right before this announcement.
Okay.
Here's where things stood as markets closed just before the expected decision. All the major indexes closed negative.
Right, saw that. NASDAQ down 0.08%, Russell 0.09%.
S&P down 0.13%, Dow Jones dipped 0.27%.
Yeah.
So, a bit of a cautious step back overall.
But not uniform, right? We're in some sectors up.
Exactly. That's the interesting part. Energy and consumer discretionary sectors actually strengthened. Suggests maybe some targeted optimism there.
Could be. While utilities were down 0.8%, real estate down 0.6%. Kind of what you'd expect, maybe.
Maybe. And the VIX, the volatility index, only registered at 16.3. That seems surprisingly low given the pressure. Didn't even cross 17.
Huh. That is low. Suggests maybe less fear than you'd think.
Perhaps. Elsewhere, the U.S. dollar weakened to 96.6. Oil was at 64.2. Bonds also weakened.
All kind of pointing towards anticipation of that rate cut, wouldn't you say? Weak dollar, weaker bonds.
Seems like it. But then you have crypto. Bitcoin reached 116,000, almost 117,000.
Wow. And Ethereum near 4,000. So strengths there.
Major strength.
So the crucial question then is, what does this mix tell us about investor sentiment right now, just before the decision hits?
Yeah.
Are we seeing cautious positioning, people de-risking, or is it more like confident speculation, especially in those growth areas like crypto?
The low VIX throws me off a bit there. It doesn't scream panic.
No, it doesn't. It's more like the market's holding its breath, but maybe not entirely in fear. Perhaps confident about the direction, if not the magnitude.
Interesting take. Holding its breath.
Mm.
I like that. And these immediate moves are fascinating, like reading tea leaves.
Mm-hmm.
But to really get the bigger picture, we need to connect this to other shifts happening, don't we?
Mm-hmm.
Especially in tech and global investment. Where might this money flow after the cut?
Right, because there's a lot else going on, like that TikTok deal.
Yeah, the deadline got pushed to December. But your sources suggest it's basically done right. Oracle, Silver Lake, and A16Z Andreessen Horowitz as the buyers.
That's the word. With Oracle handling the tech side. And crucially, the plan seems to be for American engineers to rewrite the code.
To address those security concerns about Chinese access, that's huge strategically.
Absolutely. And it's not the only big tech news. Waymo.
Google's self-driving car company.
Yeah, they just got approval to operate at San Francisco Airport, SFO.
Which is notoriously complex, right, for driving, let alone autonomous driving.
Exactly. So that's a big milestone. And then there are these massive corporate investments happening globally.
Like Eli Lilly, putting $1 billion into a new plant in Virginia.
Right here in the U.S., yeah. And meanwhile, Microsoft is apparently set to invest something like $30 billion in Europe.
Wow, $30 billion. And that follows reports about CEOs joining President Trump on a UK visit, promising big investments in England, too.
So if you connect those dots, tech deals driven by security, autonomous breakthroughs, huge cross-continental investments.
It points to pretty robust activity, doesn't it? Regardless of what the Fed does tomorrow.
I think so. It shows underlying confidence in certain sectors, certain regions. There's a momentum there that seems bigger than just short-term rate decisions. It suggests capital is already moving strategically.
And one area that keeps popping up in your sources, and let's be honest, everywhere else, is cryptocurrency. What's driving its growing acceptance? It feels like a shift.
It really does. Your sources point to a couple of interesting things. Internationally, there's this UK collaboration mention Sabi and his British counterpart agreeing to work together on crypto.
And that apparently boosted crypto stocks.
Yeah.
Bitcoin, Ethereum.
According to the analysis, yes. But maybe even more telling is the political engagement happening here.
The White House meeting.
Yeah. Figures like Tom Lee himself, Michael Saylor from MicroStrategy, Dan Ives, Priyana Chopra, reportedly meeting with U.S. officials about Bitcoin initiatives.
That's quite the group.
It is. And the key takeaway, I think, from the source material on this is the explicit shift in narrative.
How so?
It says quite clearly crypto is no longer something only criminals use. That's a direct quote.
Okay.
Instead, it's now a topic for widespread discussion, official collaboration, even White House-level meetings. That signals a huge move towards mainstream validation.
It really changes the perception, moving it away from the fringe.
Exactly. It suggests evolving policy integration into the financial system. It's accelerating.
Okay, so before we get into Tom Lee's really specific predictions, those monster moves, let's just quickly touch on the conventional wisdom. Which sectors usually do well when rates get cut?
Right. The standard playbook, you typically look at home builders first.
Cheaper mortgages, more building, more buying.
Precisely. Financials, too, banks find it cheaper to borrow, which helps lending.
Makes sense. Industrials.
Yeah, projects become more affordable, potentially boosting production. Small caps often feel less pressure, maybe benefit from regulatory shifts that sometimes accompany cuts.
Okay, and consumers.
Consumer discretionary. Companies like Amazon, DraftKings, Tesla. The idea is people might spend more if borrowing costs are lower or they just feel more confident.
Right, and tech, of course. Especially anything related to innovation, like the IoT revolution mentioned. Cheaper capital helps fuel that.
So why these specific sectors? What's the underlying mechanism, really?
Well, it boils down to the cost of borrowing, doesn't it? For consumers and businesses.
Right. Cheaper mortgages, cheaper car loans, cheaper business loans for expansion or new equipment.
It frees up cash, basically, or makes people feel like they have more cash, more confidence to spend or invest.
It's almost like a psychological boost, too, isn't it? That feeling of, oh, rates are lower, maybe now's the time.
Yeah, exactly. It stimulates demand and lowers costs for businesses simultaneously. That's the classic theory anyway.
A kind of mental cash injection, even before the real effects filter through fully.
Good way to put it.
Eh.
Okay, now for Tom Lee. His analysis is getting a lot of attention. How does he actually arrive at these bold predictions, especially given, as we said, this strange economic backdrop?
Well, according to your sources, his method involves looking back at history, but not just any history.
Right. He and his firm, Fundstrat, specifically looked for times the Fed cut rates after a very long pause,
Not just regular cuts, but cuts after a period of, well, inaction.
holding steady for ages, then making a move.
Exactly. And they highlighted two examples. First, September 1998. After a long pause, the Fed cut. And the big outperformer then, the NASDAQ 100, the QQQ. Interestingly, the Russell didn't perform as well.
NASDAQ led the way. Got it. What's the second example?
This is where it gets interesting, based on the source's reference to his analysis. September 2024, again, a Fed cut after a long pause.
And the outperformers this time.
Cryptocurrency, specifically Bitcoin and Ethereum.
Ah, okay. So based purely on those two instances.
Yeah.
1998 favoring NASDAQ, 2024 favoring crypto.
Tom Lee is predicting that Bitcoin and Ethereum are set for another, quote, monster move in the next 3 months following this anticipated cut.
Wow, that's quite specific.
It is. What's striking is that focus on rare events, isolating these long pause cuts. It's a compelling story, looking for patterns in unusual circumstances.
I mean, 2 data points. How much weight can you really put on just 2 historical moments, especially when, like we keep saying, today's economy feels different, so strong already?
That's the big question, isn't it? Playing devil's advocate, you have to ask about the statistical robustness. Are 2 instances enough, particularly given today's unique factors?
Are there any counter-arguments in the sources, maybe from that Michael Stock's channel? Do they push back on this historical parallel?
Well, Michael Stocks offers maybe a bit more nuance. They acknowledge liquidity often flows to growth areas, sure,
Right.
but they highlight that the scale of participation in crypto, now retail, institutional, is vastly different from 1998's tech scene.
So the dynamics could be different.
Potentially.
Yeah.
They suggest that while a monster move is possible, the drivers might be more speculative this time, maybe less tied to direct business fundamentals compared to the late 90s tech boom.
Meaning sharper upsides, but maybe sharper downsides too.
That seems to be the implication. More volatility, perhaps amplified by today's market structure around crypto.
Okay, so let's connect that back. What does this all mean for where the money flows now? Why does Tom Lee zero in on the Magnificent Seven or maybe 9 or 10 tech leaders and Bitcoin and Ethereum for these monster moves?
His argument seems to be that a Fed rate cut acts like, well, injecting money into the system.
Okay.
And he believes this injection will disproportionately benefit those big tech names, the AI players, and definitely Bitcoin and Ethereum.
Just a direct flow of liquidity into those leading assets.
Seems to be the core idea. He also mentions other potential triggers. If the ISM, the Purchasing Managers Index, gets back above 50.
Showing manufacturing expansion.
Right. That, he thinks, would specifically help the Russell Index and financial stocks, the XLF. Businesses feeling confident enough to sign new contracts again.
And lower rates, helping housing, obviously. Plus, money moving out of weakening bonds. Where does it go?
Into the stock market, seeking better returns, likely favoring those growth areas again.
And the specific companies he highlights in that top tier,
Yeah.
NVIDIA, Microsoft, Apple, Google, Meta, Amazon, Tesla.
Oracle and Broadcom, too. And other AI names like CrowdStrike were mentioned as potential beneficiaries. It's that whole leading tech AI cluster.
So the question is he saying these assets win because their fundamentals are just that strong? Or is it more like a rising tide lifts all boats thing, where these growth areas just capture the bulk of the new money and excitement?
That's a really important distinction. The Michael Stocks view might lean towards a bit of both. Strong fundamentals attract the initial interest, definitely.
But then the new liquidity and maybe speculative fervor amplify the moves.
Exactly, potentially creating that melt-up scenario, fueled as much by enthusiasm and momentum as by pure underlying value.
Okay, so for listeners considering these dynamics, how might someone theoretically participate if they agreed with this outlook?
Well, the sources mention for crypto exposure things like Bitcoin and Ethereum ETFs.
Which are more accessible now.
Right, or proxy stocks like MicroStrategy, which holds a lot of Bitcoin, or maybe crypto mining companies.
But this is crucial. The source is very clear, right?
Extremely clear. This is not financial advice. Tom Lee could be 100% wrong.
And these assets could plummet. We have to stress that. The market is unpredictable.
Absolutely. It's vital context. Because while the source talks about a potential melt-up, a really significant market rally if things align.
Which sounds exciting.
It does, but it also explicitly cautions that a market crash is still a distinct possibility. There's huge uncertainty. Volatility is inherent.
So it's about understanding the potential scenarios, not betting the farm on one prediction.
Precisely. Being informed, weighing the possibilities, understanding the risks involved.
Okay. Well, we've certainly covered a lot today, a real deep dive from those immediate market jitters before the decision.
The index moves, the sector rotations.
And the big global headlines, those tech deals, corporate investments. Then digging into Tom Lee's specific analysis, his historical parallels.
And the counterpoints, the nuances from Michael Stocks as well.
Right. Exploring the conventional wisdom on rate cuts versus his very specific forecasts for crypto and big tech having these monster moves.
It's really a fascinating mix, isn't it? You've got this underlying economic strength clashing slightly with the anticipated rate cut, then overlay the rapid tech evolution AI, autonomous driving, and crypto going mainstream.
It all converges right now.
Yeah, and that potential for a melt-up is intriguing, no doubt. But those risks are just as real. It really hammers home the need for critical thinking, for looking at diverse perspectives.
It's about weighing those historical patterns Tom Lee highlights against the unique conditions we see today.
Couldn't agree more.
So as you, our listener, process all this information, and as we all wait for the actual rate decision, what stands out to you? What resonates? And maybe consider this thought. We're in this era where huge central bank actions are meeting an incredibly fast pace of technological change, AI, digital assets becoming normal. Are we maybe entering a new kind of paradigm?
Interesting question.
Do the old market indicators still work the same way? Could this unique blend of forces truly lead to that melt-up? Or is market volatility about to surprise us again, maybe challenging all these assumptions about where the next monster move really comes from and how long it might last?